Hey everybody, my name is Tom. I'm a partner at RedPoint, and a little background on me. I was a founder of a software company in 1999. We built software for law firms, and then I studied computer science at Dartmouth, mechanical engineering, computer science, like autopilot systems, and then I was a Java engineer at a DC-based SaaS company called Appian, and I built systems for the U.S. government. And then I was at Google, so this is a familiar environment. For 3 years, and my wife actually and I met here, and she works like 2 buildings away. So we're having lunch after this. And then now I've been at RedPoint for about 8 years, and I focus on early stage software companies. And I write a blog at tomtunguz.com, and I wrote a book. It's coming out June 20th called Winning with Data. Awesome. So today the format of the presentation is 40 minutes. I'm going to run through about 25 slides. All of them have data. So if you have questions, just stand up and raise your hand. I want it to be as interactive as possible. I'm here for you guys. And the point of the presentation for the first half is really to talk about what we're seeing as investors in the market and what that means for startups. And then the second half will just be Q&A. Sounds good? Awesome. Cool. So RedPoint, we're a firm that's been around since 1999. We manage about $4 billion. We financed 434 companies, and we've sold or taken public 136 of those. These are some of the software companies we're lucky enough to partner with. So let's jump right into it. Investment outlook for SaaS. So in terms of SaaS penetration, if you were to take a look at, if you were to sum total all the revenue of publicly traded software companies, how much SaaS revenue they're actually generating, you can see it's growing on a nice geometric curve, hitting about $25 billion. These are only pure play SaaS companies. This does not include things like Concur being sold to Ariba. Right, for example. So it's pretty big, right? And if you take it on a percentage term, we're about 14%, which was much higher than I was expecting. So actually, we're pretty far in the penetration curve, all things expected, right? But it's going to continue to grow. There's going to continue to be a shift, and that's why we're continuing to invest in the space. And if you break it out if you take a look at the revenue by average contract or customer value, where SMB is defined as less than $10,000 ACV, mid-market is defined as less than $100,000, enterprise is anything above, you can see that SMB and enterprise are roughly about the same at about 5, and mid-market are the most common companies. So this is like Salesforce, Marketo, and that's where more of the revenue is. The point is here that there are many different ways to build a business, and a bunch of the analyses that we've done at RedPoint show that you can acquire customers just as cost effectively targeting the SMB, the mid-market, and the enterprise. But this is kind of how the numbers break out. Any questions? Cool. So the big change in 2016 is that all of a sudden profitability matters, and it hadn't in the past. And so if you take a look at publicly traded companies, you can see this is their profit margin or their net margin. You can see for a long time, as the cost of capital was decreasing, publicly traded SaaS companies were becoming less and less profitable in order to grow faster and faster. And so they went from about break-even in 2011 to losing negative 25% profit margin in 2014. And then since the correction in February of 2014, the first SaaS correction in 2014, and the second SaaS correction in early 2016, they've come back up to about negative 10%. So profitability even matters for these big guys. And if you were going to break out all those SaaS companies by quantile, you can see that the worst offenders are moving up the most. The second worst offenders are moving up a little bit, and then the people who are about profitability are staying the same. So what does that mean for the fundraising market in 2016? To put it into context, if you look since 1995 to 2015, the 5 best years for VC investment, 2 of those have been in the last 2 years, right? This is on an inflation-adjusted basis. So we are at historical highs. There's about $43 billion raised last year. And if you were to look at it from 2010 to 2016, you can see that in the seed, Series A, and Series B, we are also at historical highs. So this chart shows, so the left one is seed, the middle one is Series A, the next one is Series B. It goes by year, so from 2010 to 2016. And it shows you the investment amount in dollars indexed to how much was invested in 2010. So the amount of money on average invested in 2010 is 1. So that means that seed stage investments have gone up 5x in 5 years, which is amazing. And Series A investments have gone up 2x in the same time period, and Series Bs have gone up 3x. But in Q1 of 2016, we saw kind of our first big dip, so 18% down in seed, 15% in A and 26% decline in B. The takeaway here is, yes, there are a bunch of fluctuations that are happening because of whatever's happening in the public markets, and that's rattling investors. But on a historical, looking at it from a historical lens, through a historical lens, you can see that we're really still, there's a ton of capital in the market there to be invested because, one, VCs are raising historically high amounts of money, and two, on a relative basis, we're still at very elevated levels. Obviously you guys know the publicly traded SaaS median, the forward revenue multiple, which is how many of these businesses are valued, has fallen by about 57%. It's corrected a little bit since January, but it's really rare now to see a company with an 8 times forward multiple, and so the valuations of these businesses, both in the public market and the private market, are different than they used to be. So just to give it an anecdote, it used to be we would pay at the Series B or later 15 to 20 times forward for an exceptional SaaS business, and now it's probably closer to 10 to 12 times forward. So there's been probably a 30 or 40% correction in the private markets. 2/3 of founders believe in 2016 fundraising will be somewhat or much harder. The data is still kind of out. If you take a look at the number of dollars raised by SaaS companies per quarter, you can see that in Q1 it was relatively flat. Compared to historical highs. So there's still a lot of money going into the sector. This is a chart of the median SaaS round sizes for the A, the B, the C, and the D. And you can see that they are flattening out. The median SaaS Series A is around 6 million. The median B is right around 13. The median C was a spike. There's a bunch of anomalous data points here, so I wouldn't put too much weight into that. And then the Series D is declining at around 25. Cool. We ran a study internally because we have a database of several hundred SaaS companies, and we looked at the premium SaaS companies, in other words, the ones that are growing the fastest, the ones that we believe will be the most valuable, and we benchmarked their performance to get a sense of what does a Series A for those businesses look like. Just a couple of notes on the analysis. There's clearly a selection bias in this analysis. We're cherry picking what we perceive to be the most valuable businesses. The second is there's a sample size bias. We're only looking at about 10 to 15 data points per year, and just kind of give you a sense that the revenue growth rate median is about 5x at the Series A. So they're probably going from like 500K MRR to, 500K ARR to 2.5 or 1 to 5, something like that. So this is the median ending MRR by quarter of those companies, just to kind of give you a more visceral sense of what it looks like. And the average Series A is right around 9.5 million for these companies. You can see that there's a nice distribution to it. Yeah. And what's interesting is over the last 3 years, the median Series A for these businesses have gone up. And the reason they've increased is because a lot of these companies, they get further by the time they raise their Series A. And that's because the seed round sizes have increased. Median seed round has increased from about 900K to 1.5 million over the same time period. If you have 50% more capital, it's going to give you a little bit more runway. You're going to have a greater revenue, and so you'll be able to command a greater valuation, which means you can raise a larger round. And this kind of proves the point, right? So the average Series A MRR in 2014 was 50K when they raised for these companies, 112K, and then through the first quarter of 2016 was 163K. But that doesn't tell the whole story. So 27% of Series A's actually raised with 0 in MRR. Right? So for every benchmark here, there are a whole lot of exceptions. That's kind of the point of this slide. And this is definitely reflected in our investment patterns too. So the role of metrics and valuations. So at the Series A, what is the biggest driver, or what is the most important driver of pre- and post-money valuation? There's a weak relationship between MRR and post-money. The correlation coefficient is 0.3, which means 30% of the variance can be explained by your MRR. There's also a really weak relationship between post-money and next 12 months revenue. In other words, how fast you're growing. It turns out, and I ran the analysis today, which is why I don't have the chart, it turns out that the biggest, the most highly correlated variable of a SaaS company to its pre-money valuation or its post-money valuation of the Series A is negative net churn. And that explains about half of the valuation. And that makes sense from an investor's point of view because negative net churn indicates, one, really great product market fit, and two, long-term capital efficiency of the business. Cool. Those are all the slides. I got through that really fast. Awesome. Any questions on the slides or questions about the fundraising environment?